For the last half-century, global trade relied on a specific guarantee. If a region destabilized or a trade route was threatened, the United States military would step in and restore order. But in the Strait of Hormuz, this localized conflict is successfully choking off global shipping and driving up oil prices, despite the presence of the U.S. Navy. The mechanics of warfare have caught up to the empire. We are now seeing $15,000 drones routinely threatening $10 billion aircraft carriers. While the U.S. invested its resources into massive legacy systems, opposing forces adapted to cheap, decentralized technology to circumvent them. This regional struggle has called the American military bluff, creating a vacuum of uncertainty that now ripples through the entire global economy. For decades, companies maximized profits using a just-in-time model, stripping away inventory and relying on perfectly timed, unprotected shipping lanes. Without guaranteed maritime security, corporations are forced into just-in-case logistics, building warehouses and hoarding physical inventory simply to survive supply chain interruptions. While the United States drains its strategic oil reserves to temporarily suppress domestic gas prices, China has taken a different path. They have quietly built the world's largest stockpiles of oil, electricity, and fertilizer. When nations can no longer rely on the oceans, they move inland. Countries across Asia are scrambling to redraw their supply lines, laying down new internal railways and pipelines to bypass waterways Washington can no longer secure. The physical infrastructure of global trade is fracturing into regional defensive silos. The highly efficient globalization led by the United States is breaking apart. To understand how we arrived here, we have to look back to the 1970s. As American manufacturing lost ground to recovering economies in Europe and Japan, the United States needed a new financial mechanism to maintain its economic supremacy. The solution was an agreement with Saudi Arabia and the Gulf states. The United States would provide unconditional military protection to these nations, and in exchange, the world's oil would be exclusively priced and traded in US dollars. This flowchart shows the financial trap. Nations needing energy acquired US dollars. Oil producers collected vast surpluses, funneling them directly into US Treasury bonds. Forcing the world to hold its currency let the government issue endless debt, funding conflicts like Vietnam without taxing citizens. This petrodollar arrangement allowed the United States to transition away from a productive manufacturing economy, becoming an empire subsidized by foreign lenders. That entire system relies on the promise of American military protection. Recent missile strikes on Gulf energy infrastructure have proven that hosting an American military base does not provide a shield. In modern asymmetric warfare, it turns the host nation into a target. Because the United States can no longer guarantee the physical security of the Gulf, it cannot fulfill its end of the bargain. The oil-producing nations are no longer obligated to uphold the dollar monopoly. The military vulnerability in the Middle East is the trigger severing the foundational financial lifeline of the American economy. This chart compares U.S. economic output against its borrowing. With over $31 trillion in public debt, borrowing has eclipsed the entire gross domestic product. This debt wasn't used for factories, but for stock buybacks, a maneuver enriching the top 10%. Meanwhile, the American working class has been hollowed out by decades of deindustrializations. To survive stagnating wages, consumers have piled on record-high, unproductive credit card and auto loan debt. The domestic economy is dependent on a continuous stream of borrowed foreign money, and those foreign lenders are beginning to realize the scale of debt may never actually be paid back. The symptoms of this unraveling are visible in the macroeconomic data. The major American credit rating agencies have officially downgraded the creditworthiness of the United States from AAA to AA. Lenders are factoring in the risk that a bitter, politically divided working class will eventually refuse to pay taxes to a government that continuously funnels their money toward foreign creditors and the ultra-rich. Compare this highly indebted system with the structure of competing powers like China. Their hybrid command and control economy is built to rapidly mobilize resources from the top down, allowing them to absorb massive global shocks while maintaining high growth. When an empire can no longer manage its structural rot or compete economically, it resorts to desperate overreach. We see this in the erratic application of tariffs, the overuse of economic sanctions, and the increasing reliance on extrajudicial military strikes. The convergence of military vulnerability and massive internal debt is dismantling the petrodollar system. As this foundational financial lifeline snaps, the era of American global supremacy